Some people say China's economy is collapsing. They point to falling stock prices, a struggling property market and rising debt. Headlines scream of a looming crisis. But is China really on the brink? The truth is more complicated. China's economy is not collapsing, but it is slowing down. This slowdown is real and serious, but it's not a crash. Think of it as a car running out of fuel. It will slow down and eventually stop if it doesn't get more. China's economy is facing strong headwinds. After years of rapid growth, the engine is sputtering. The days of double-digit growth are gone. The country is grappling with deep-rooted problems that need urgent attention. To understand the situation, we need to look beyond the headlines and examine the underlying issues. One of the biggest problems is the property market. For years, China experienced a building boom, with new apartments and houses going up at a dizzying pace. But this boom has turned into a bust. Many new apartments are empty, and prices are falling. This is bad news for the Chinese economy because the property market is a major engine of growth. Another challenge is weak consumer spending. People in China are not spending as much as they used to. This is partly because they are worried about the economy and the falling property market. They are also worried about rising debt and job security. When people don't spend money, businesses suffer and the economy slows down. Local governments in China are also facing a debt crisis. They borrowed heavily to fund infrastructure projects, often relying on land sales to repay their debts. But with the property market slumping, land sales have dried up, leaving local governments struggling to repay their loans. This is a major risk to the financial system. Finally, China is experiencing deflation, which means prices are falling. While this might sound good, it can actually be a sign of a weak economy. When prices fall, people delay purchases hoping for even lower prices in the future. This further weakens demand and slows down economic activity. The Chinese government knows it has a problem. It is trying to boost the economy with stimulus measures. These include cutting interest rates to encourage borrowing and spending, as well as investing in infrastructure projects to create jobs. However, these measures have had limited impact so far. The government is also trying to tackle the local government debt crisis. It has launched a debt refinancing program to help local governments repay their loans. However, this is a band-aid solution. The long-term solution is to reduce the reliance on the property market and find new sources of revenue for local governments. The road ahead for China's economy is uncertain. The country faces significant challenges and there are no easy solutions. The government's focus on stimulating manufacturing and exports might provide a short-term boost, but it won't solve the underlying structural problems. Moreover, the global economic slowdown and rising geopolitical tensions add to the uncertainty. China's export-oriented growth model is facing headwinds as demand from key markets weakens. The ongoing trade war with the United States also poses risks to China's economic outlook. However, China also has significant strengths. It has a large and growing middle class, a skilled workforce, and a government that is committed to economic development. If China can implement the necessary reforms, it can overcome these challenges and continue to grow. In conclusion, while China's economy is not collapsing, it's facing a period of significant uncertainty and transition. The challenges are real, but so are the opportunities. The coming years will be crucial for China as it navigates these choppy waters and seeks to find a new, more sustainable growth model.